Hello and welcome to this CNBC Africa special. I'm Chris Bishop. Well, the nightmare is far from over. After many months of uncertainty, the cases of COVID-19 are still rising in South Africa despite all the precautions. Aside from the mortal risk of the pandemic, what about the financial aspect? That's a question a lot of people are asking. What should people be doing with their money? Well, on the line with me, I have a man with some of the answers to those questions. His name's Viresh Maharaj, the Managing Executive of Sanlam Corporate Distribution. Just to start off with, just give viewers an idea of context. You've obviously been working in this business for quite a few years. Have you ever seen anything worse than what we're going through right now?
And hi to all the viewers. We're certainly going through very interesting times, as the saying goes. And I think that it's a test of resilience on many factors, not just of government and our response to the pandemic, but of ourselves as a society, as communities, as family, and as individuals, and how we respond to the various challenges that the pandemic brings to our doorsteps, including the impact of the lockdown. In our specific space of retirement funding at Sanlam Corporate, we've traditionally done research in the employee benefit space, going back to the early 80s, where we started the Sanlam Benchmark research with a view to exploring the experience of retirement funds through various challenges and changes back from the 80s. All of the volatility that we've experienced since then up until now, in order to empower stakeholders to make better decisions that empower members to achieve better outcomes in retirement. Now, with the impact of the pandemic and the lockdown, we believe that it was relevant to conduct such research very recently in order to empower stakeholders at a point in time where great uncertainty persists on how we as a financial services industry and as well as retirement funds and employers should respond to meet the needs of our employees and members.
So obviously you deal with customers from all walks of life, all industries across the country. What's your general assessment of how employers have responded to meet the financial needs of their people in very difficult times?
Chris, that's one of the aspects of the survey which we explored, is to understand the experience of employers during this time. A question asked was, we recognize the financial constraints on employees and the need for financial relief. And therefore, we queried the respondents as to how did they actually believe the best mechanisms were implemented to provide such relief. Now, the most popular of these mechanisms was that of temporarily suspending retirement fund contributions in order to provide a temporary uplift in net income through to employees. Here we found, at the point in time when we conducted the survey, that about a quarter of respondents had indicated at that point in time that they had actually suspended retirement fund contributions. About 9 in 10 employee benefits consultants surveyed had also indicated that they had at least a client which had done so. Now, knowing what our own administration data within Sanlam provided us and how the numbers have shifted over the course of the lockdown, we would fully anticipate that many more employers across South Africa have actually suspended retirement funding contributions since the reported figure of 26%. Now, to put that in context, on average, and averages can be very dangerous things, so we've got to take them with necessary precautions. But on average, based on average contribution rates and average tax rates, we find that the average net uplift in the average South African's employee due to a suspended retirement funding contribution is in the region of 1,500 Rand per month, which can be compared to the special COVID relief measure of 350 Rand a month, payable to unemployed persons, as a means of getting a comparison on the relative impact of these measures. 1,500 Rand on average makes a meaningful difference in the life of a typical employee. A question or a fear that was raised, it seems, amongst many employers during this time, is whether or not suspending retirement fund contributions would have a negative impact on the members' ultimate retirement outcome. And fortunately, what we found is that based on projections, and again, based on relatively conservative assumptions, the impact on one's final retirement fund value ranges between 1 to 3% of that final value, depending on the duration of the suspension. That's hardly material, especially considered against the very material need for survival right now.
How difficult is it, when you're talking to customers as well? Because a lot of people have completely lost their income, not just they've had a pay cut or what have you. What do you say to people in that kind of a situation?
It's a very difficult conversation, Chris. And this is where I believe that for those who do have access to financial advisors, to make use of the capability that's available, to find mechanisms to help provide some form of financial resilience and to consolidate one's budget, as well as perhaps potentially luxury type items. And in these circumstances, I think the definition of what is considered a luxury changes dramatically. And as a nation, and I guess the viewers of your show would well appreciate this, we're all experiencing very tough times. As a nation, we're in financial distress, and that boils down to households themselves. And this is where support is needed in order to identify those measures. Prior to the pandemic, one of the key disablers of financial resilience was that of South Africans' high levels of debt. And this is an issue that's persisted for a number of years. And due to the economic impact of the lockdown, we anticipate that this will exacerbate over time. But this is where solutions, where using aspects of the fourth industrial revolution, they're able to connect with individuals and help them to manage their debt down, either through consolidation of the debt itself or by identifying superfluous expenditure on their behalf and helping them to manage their budgets better in order to free up capacity in order to address their issue of debt have become available. And we do anticipate many more of these mechanisms coming online in the near future as the financial services industry is grappling with the challenge of how to stay connected with our consumers through these remote working conditions.
And so in this new normal that everyone's talking about at the moment after COVID-19, do you think that it's going to see the death of this sort of superfluous spending that many people have been prone to in recent decades?
So Chris, for what it's worth, my opinion is that on various aspects, including the one we're under discussion now, we've all swung, or the pendulum has swung very far in one direction. And while it might swing back a bit, I don't think we'll ever go back to the way that things used to be. While we did not explore this specific topic in the research, various supplementary material as well as anecdotal conversations that we've had with a number of consumers indicate that there is very much a need to review their financial priorities. In fact, in one of the focus groups that we conducted amongst individuals aged 25 to 45, so bordering around the millennial generation, just with a few abnormalities on the fringes. But what we found was that while various financial needs were present in their lives, the lowest ranking financial concern that they had, or capability at that time, which again was pre-COVID, was that of having emergency funding available. So to have a bit of a buffer to take one through tough times. We would hope that the experience of the lockdown makes the need to have those emergency savings far more prominent in the lives of consumers, not just in South Africa, but around the world. And this is where we believe that financial inclusion has a key role to play. Because typically, we do have low rates of financial literacy in South Africa for a variety of reasons. And only the middle class and the wealthy are able to access the capability of financial advisors typically. Now, through various mechanisms, including the important mechanism of retirement funds and the workplace, we are able to make financial advice more accessible in an inclusive manner across the income spectrum. And in doing so, enable financial inclusion for a far broader range of South Africans than ever before.
So how much do you think of all the things that are going on right now around COVID-19, do you think, how much do you think this is going to accelerate the move to so-called umbrella funds?
Well, it's an interesting question. And I think that to provide context for many of the viewers, Um, Within retirement funding or occupational retirement funding, you typically have two popular structures right now. What's called a privately administered or a standalone umbrella fund, standalone fund, which has its own board of trustees and own set of rules. And then you've got umbrella funds, which cater for multiple employers to participate within that single umbrella fund. And over the course of the last, I want to say 12 to 15 years, we have seen a dramatic consolidation from standalone fund structures into these umbrella funds. To give you a bit of context, over the past 10 years, based on FSCA data, we found that over 1 million members joined umbrella funds in that period, and quite specifically, the big five umbrella funds in the industry. So that represents a dramatic shift up until now. What we anticipate is that that consolidation will continue into the future as a result of the economic impacts of the lockdown, as many employers would start to question their expenditure, and not just in terms of just what they spend in money, but where they spend in time, and the time taken to run a standalone retirement fund compared to participating in a professionally run umbrella fund. And so we would think that that would be a key driver towards the move towards umbrella funds, taken in addition to the implementation of the default regulations last year, which has very much brought the umbrella fund question foremost in minds of many current standalone funds themselves.
I'll ask you a question I'm sure a lot of your customers are asking right now. In the middle of all this, I mean, how are insurance costs likely to increase?
So there's probably not great news on the horizon. For those of you familiar with group risk, and again, for the context of your viewers, in life insurance, you typically have two broad sets of policies. Retail or personal type policies, where you buy a policy on your behalf, typically through an advisor or increasingly now online, and the policy belongs to myself as the individual. Or you get what's known as group cover, which you receive by virtue of being employed at a company that has purchased a policy on behalf of its employees, or a retirement fund that has done so as well. So in the group insurance space, unfortunately, a significant minority of employees and retirement fund members are not fully aware of the cover that they do have. And so that's probably a first port of call, is to understand, do you have cover and how much that is, before making any further financial decisions. But when it comes to group insurance specifically, we find that with group cover, both mortality, so the rates of deaths, as well as morbidity, the rates of illnesses or disablements, tend to be correlated with economic growth. So when the economy takes a downturn, we find that there's a lagged increase in both deaths and disablements amongst our client base, and that cuts across the industry itself. Now, given South Africa's unhealthy trajectory when it comes to GDP growth, the industry has experienced a number of years of poor claims. And what that's resulted in is year-on-year rate increases, particularly in the space of disability income insurance. So this is where an employee becomes disabled and receives an income on a monthly basis from the insurer as a result. Now, that specific product line has taken quite a knock over a number of years, and because of the link to the economy. And it should be no surprise to everyone watching this right now that with the expected at least 7% in the contraction in our GDP, our economy will suffer, and we would therefore expect more claims on this disability income product line. And as a result, we expect prices to increase into the future. So not great news.
Not great news, I'm afraid. So what can companies do to try to cut down their costs, to try and ameliorate what you're talking about?
That's another angle that we explored as part of the benchmark research. And we asked employers as well as benefits consultants. And Chris, maybe just to emphasize that before I answer your question, just to put some context around benefits consultants. So if you do have a retirement fund through your employer or a group insurance arrangement, typically you would have a benefits consultant providing advice to the board of trustees or to the employer themselves. And high quality benefits consultants play a meaningful role in helping to improve the financial outcomes of their clients whether or not those clients, the actual end members and employees, are ever aware of the role that they're playing. Now, the benchmark research is one of the few, if not only, tangible mechanisms to evaluate the, 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 the sentiment and views of the community of benefit consultants in South Africa. And a benefit consultant typically has a number of clients, upwards of half a dozen or so on average, and their views are the aggregate views of their client base. And so we've polled them to get their views. Now, we did ask the benefit consultants as well as the employers we queried what would they do should we see this anticipated increase in disability income insurance costs. And the results were fairly mixed, with the most popular response being that they do not yet see the need to reevaluate these structures. And that may simply be a function of the lag between the economic cycle, the claims cycle, and the rate review window of insurers. But when those rates do increase, the next most popular option was to change from what's called flat benefit structures, with 75% of insured income as a benefit being the most popular, to what's known as a tax scaled structure, which aligns to the SARS income tax table, and in doing so, provides a more appropriate benefit for the individual and helps to manage the costs of the employer, and therefore the costs that are eventually passed through to the remaining employee base as a result of the actual claims experience on that employer.
I'll say you've been, just to change tack a little bit, you've been in this industry a very long time. What was your assessment of the way investors handled this tremendous market crash we've seen over the last few months?
As you said, I've been in this a long time twice, and I'm starting to wonder if this Zoom camera is making me look a lot older than I think I am. But to put it in context, if you consider the experience of investors over the last 12 years, I think to put it mildly, it's been wildly erratic. And let's just think of what an investor's had to go through, especially one who started investing just not too long ago. From 2008 onwards, we've had the great financial crisis. You've had multiple tranches of quantitative easing. You've had Brexit and more Brexit and more Brexit after that. You've had Donald Trump, the European debt crisis. We've had various gates, including Nenegate, Steinhoff, amongst other commercial failures. And now the economic impact of the lockdown itself. And locally, it's had an effect, and globally as well. And we've seen various degrees of bounces in the market, but it's anyone's guess as to where that will go. But to characterize the last 12 years, the best way that we can do it is to call the past 12 years volatile. So let's think about the future then. I've alluded to this very briefly. Let's think about what the future holds. So we've got an alphabet soup of economic recovery patterns, from V to W to U to L, and to any characters in between. We've got the US elections in November, which is still a very long time away. We've got actual Brexit. You've got geopolitical conflicts, both hot and cold, potential future pandemics. Unfortunately, it seems every time I check the news, it sounds like they've found something new that's popped up in some strange corner of the world, and it does get you a bit worried. And other potential black swan events that haven't even touched down yet. So to put it in different words, we expect the future to also be unpredictable, and we would expect the market to be volatile as a result.
What lessons do you think investors and fund holders have learned in the last 6 months, maybe as they didn't learn the previous 6 years?
Well, Chris, it's an interesting question. I think there's an old saying that those who don't learn from history are doomed to repeat it. And given that we have experienced significant volatility and we can anticipate further volatility, we've seen an increase in the interest in investment portfolios that offer some form of smoothing of investment returns over time, or investment guarantees as well. We've got about 10 and 13%, 10% of benefit consultants would be exploring this for clients into the future, and 16% of employers and retirement funds have said that they would be exploring implementation of such products as part of their portfolios. Now, typically, for investments, given the impact of the default regulations, all retirement funds have to have an investment default strategy, or a default investment strategy, and the bulk of those, upwards of 60-ish%, are invested in what's known as life stage type structures. To put that quite simply, while you are young, and young means up until your early 50s, according to these structures, you're invested fairly aggressively in either aggressive or moderate aggressive type portfolios, typically balanced portfolios, according to Reg 28, because you're assumed to be able to manage the waves of volatility and you'd be able to recover from any market downturn over the long term. As you approach retirement, though, as you get older and you're getting towards retirement age, you are progressively switched into lower volatility type products, into more conservative portfolios. For many retirement funds, this would be a more conservative balanced fund. And the conservatism is enacted through the asset mix itself, either through investing in less volatile categories at a high proportions or increasing diversification. Now, the problem here, and this is the lesson from history, is that when shocks happen, fear sets in, and these diverse asset categories tend to move in similar directions. So the correlation between diverse asset categories starts to narrow, or starts to increase actually, and they move together directionally, especially at the time when you need it the least, and when you, as a pre-retired, when you've got the most accumulated in your fund, the least time available to actually make up the difference. And it's at this stage that we believe that guaranteed type products are most appropriate for pre-retirees. Two additional points here, Chris. So in my role as the head of distribution for Sanlam Corporate, I get involved in a number of engagements with clients, both consultants as well as employees themselves. And what I've found through the years of engagement is that there is a stark focus on the accumulation portfolio. It's almost the shop window for retirement funds. It's almost the ego muscle of a retirement fund investment strategy. So how do we compare that? And we often spend a lot of time on behalf of clients making those comparisons. What I can say is that the amount of time spent in comparing pre-retirement portfolios is far, far less. And this could be due to a variety of reasons, including various biases that we have as individuals when comparing these structures. But what that means is that those pre-retirees are potentially exposed to unnecessary market volatility at a time when they can least afford it, even if they are invested in conservative portfolios pre-retirement. And hence the increase in the appetite to consider investment guarantees at this particular stage.
I'll say one particular thought that's been expressed quite often in these last few months, where we've been covering COVID-19 here at CNBC Africa, is that some of the more well-heeled companies with healthy balance sheets should be perhaps ploughing that back into the economy to try to help the South African economy revive itself. I mean, how do you think retirement funds and the kind of investing you're talking about can help to rebuild the South African economy?
I think that's a pertinent question, Chris. And there's been a lot of discussion and talk around this for a number of weeks now. And a lot of it is couched in conversations around prescribed assets and various other mechanisms. And because of that, we actually did pose this question to respondents. And what we found was that the results were very clear and quite distinct. The most popular option in the survey, as selected by consultants as well as employers and retirement funds themselves, was to make use of the significant pool of unclaimed benefits that exist in the industry to beneficiate poor communities and or the economy at large. Again, many of your viewers may be aware that the figure that's bandied around is that there's about 42 billion rand in unclaimed benefits that exist. And the harsh reality is that the majority of qualifying members will never apply for those benefits for various reasons. So that a big chunk of the money will stay latent, and the opportunity therefore exists to unlock a significant proportion of that money in a responsible manner and invest that appropriately so that it can help to reignite South Africa's economy. But it's not up to unclaimed benefits alone, even though that was the most popular option in the survey. The next three most popular options selected by respondents all relate to the use of impact investing, ESG type investments, or the use of alternatives and other vehicles to improve the state of SA Inc. And that speaks to investing in various types of projects with a view of enabling stronger communities, the stronger economy over the long term, and very much brings into conversation a sustainable infrastructure development. And there's been a number of conversations around this, including the President's Sustainable Infrastructure Development Symposium held a couple of weeks back. I do want to say, though, that on behalf of our respondents, which included about 140 benefit consultants, and I say again that they would be the aggregate views of their clients potentially as well. So it's a bit broader than just 140, as well as 230 employers and retirement funds across that sample. The least popular options that they selected by some margin were the implementation of prescribed assets, as well as increases in taxation of retirement funds, or the reduction in the relief provided on contributions to retirement funds. Now, sorry, Chris, I must mention that as a corporate, Sanlam does take its responsibility quite seriously. And apart from the contribution that we've made directly to impact COVID relief mechanisms, we have, through Sanlam Investments, made available the legacy range, which is very much a vehicle aimed at meeting this very specific need.
And just lastly, very briefly, Viresh, I mean, we've talked about a lot of heavy subjects in the last 25 minutes, but just before we finish this CNBC Africa special, can you leave us with perhaps a little bit of hope for us all to hold on to in these difficult times?
We've said this at our Benchmark Symposium, which we held earlier this morning, subject to a few different technical difficulties, which we're all grappling with as we move into a very new world. But one of the points that we make is that we've got to, as an industry and as a society, reconsider the role of retirement funding and its relevance to modern day consumers. As a bit of a history lesson, the first retirement fund was implemented back in the 1880s by Chancellor Otto von Bismarck. And this was in response to political and societal pressure because the needs of workers at that stage had changed. Prior to then, you either worked yourself to death or to the bone, and if you weren't earning an income, you did not have an income, and hence the need for a state pension. So there's a dramatic revolutionary new vehicle was introduced at that stage. Now we're at a position in our own story as an industry and as a country of needing to reevaluate the societal needs as well as the political and economic needs of retirement funds and how retirement funds can play a more relevant role in the lives of our members. And the comment we've made is that we have a limited opportunity, a window of opportunity to play that role. And we've got to seize that opportunity to make a real difference in our ultimate stakeholder, the individuals themselves, the members themselves. The time is now for us to plan, the time is now for us to reflect, and right now is the time for us to act.
Thank you very much indeed. That was Viresh Maharaj, the Managing Executive for Sanlam Corporate Distribution. I'm afraid that's all we've got time for on this CNBC Africa special. From me, Chris Bishop, and the team, it's goodbye.